All right, let's talk about the stock market right now. The stock market is in a condition where it has weakened significantly. Now, we've seen quite a number of weeks in here where the stock market has come off of its highs, and the SPX, I'm actually going to show SPX, not SPY. The SPX or SPY, fell about 12% and then rebounded, and bigger declines by the NASDAQ, about 16%, and 22% by the Russell, which had a little bigger bounce this week. And the world markets have actually been in declines for a longer period of time. Well, it kind of aligns with the breakdowns of a lot of the stocks that did well from the pandemic and the tech stocks that really started to come apart on the discussion of the interest rates going up. So it was a kind of disguised breakdown for the U.S. market. Well, it wasn't so disguised for the FEZ, which is the European market, and the EEM, which are markets that are really around the world, emerging markets, they call that. We're going to look at all of that right now. We're going to start out by looking at the SPX. So here is the SPX, which is a look at cycle analysis. Let me just move this out by a little bit more in here. You could see what we call this larger harmonic families in there. And the movements that are in here, as you could see, these are what's called cycle brackets on the bottom. Some people write me, what are those half moons or half circles are on the bottom? These are a drawing tool. I mean, these are not the cycles, but they're a guide for us. They tell us where to look for the energetic forces in the market. Our analysis looks at three major components: the cycle analysis, which is the energetic movements that you see right in here; the condition of momentum, which is reflected right over here on our reversal scout, which I just spoke about, which is available for our level 4 members and level 4 plus, and our support and resistance levels, which are very key, and we have videos in our video library about how we do the swing high, swing low analysis. Each of these dominant cycles that you see right in here are made up of actually 3 minor cycles, and those are illustrated right in here. And these have all 1, 2, 3, 4, 5, 6, 7 in a row were all what we call positively configured. Higher highs, higher bottoms, that gives you the uptrend. This one changed and is now negatively configured with another whole period right in here where it is likely to move to the downside. When you get into periods where they nest or 2 of them come down together is where you get your biggest declines. When you add in the much bigger cycle right in here, and that is the 20-month ideal cycle that you see, that happens to align with declines that are coming up in 40 and 80-month cycles that have important troughs in the spring, summer, and maybe even out into the fall. That puts a lot of downside pressure in the market. So in this case, right over here, you have 1, 2, and 3 cycles that have energetic forces coming down. If you want to think about what this looks like, it would be kind of the shorter-term holders, the intermediate holders, and the long-term holders. For the long-term holders to start to liquidate, they have to really be under pressure, and we're coming into a period where that is coming up, and that means a lot of supply could come onto the market. Let me just take a little closer look right in here as we look at this, and we want to consider the fact that this big decline came down 12%, came into this resistance area, and you could see what's called a tweezer that formed in here. There's 2 high waves right there. It's suggesting that this level right there, which is the 50% retracement, is stopping it. And here you could see the S-Slim reversal scout in negative momentum condition. When you get into shorter-term negative momentum conditions, which we've been in and out of, those set up for downward impulses. So for those of you that are members and use the slim ribbon, which are slim ribbon PO, when that turns red and this is red, you got periods of trouble. And we think this is a period of risk. Each of these yellow zones are a period of risk, and we have that right over here. That is suggestive of a decline coming. Now, it's the probabilities of taking out 42.24 are better than 2 to 1, maybe even 3 to 1, based on this structure that we're looking at here. It could come down here, get support at 4,200. It could get down here to around a 50% correction level around 4,100. And if it wants to get way down to this major 38, which would be just over a 20% bear market, that's around 3,800 down there. So this is a period of risk in here, and these rallies should fail. Now what I want to do is I want to compare a little bit as we look at the FEZ. Now remember, this is pointing to a decline out into these two vertical lines, kind of give you the principle of variance right there, where it could early bottom in mid-March or late March, or it could go all the way out here into beginning of May, depending on how long the selling process takes. Now, if I look at the FEZ in here, which is the Euro Stoxx, you can see something very similar. It's interesting that while the U.S. market peaked out over in this area, this one actually peaked way back here last June. Now, it gave you this negative period right in here, which you can see is a nesting. There's those similar cycle patterns right there, and this period of risk right down over there. It's likely the downside risk goes into late March into May. That's very similar to what we see in the U.S. markets. And here are your supports and support confluences, which come off of these major lows that come in here. And you could see that it's pretty reasonable that it's going to get below 43, which would only be, another 5% or so, but maybe the way down over here to 41 or into this area is under 40. So this is your period of risk, very much in alignment with what we see in the U.S. market. Again, you want to learn more, go to AskSlim.com and go to our cycle analysis page. And there's a video there that introduces cycle analysis to you. It's very informative, so watch that over there. So this is the Euro Stoxx 50, and FEZ is the symbol, and you could see the beautiful formations of flags. In our cycle analysis workshop, we teach how flags form, how the minor cycles fight against the dominant cycles. In this case, dominant cycle had an upward force, so did the minor, and you see we got above and tested the high. In this case, it didn't test the high. It tells you this force over here is gaining a hold, and you can see that happening as you create this negative shape in here, and both of them about to come down on the downside. So that is a look at FEZ. Now let's take a look at EEM. And you can see, looking at EEM, there's similar things going on here. This happens to have what we call out-of-phase cycles. So there are two cycles that are exhibiting force in here. You can see the bottom right there and there. That's the blue dotted one there and right there. And overall, this downward trend you see comes all the way back to last February. So the emerging markets have been in this declining mode for some period of time, pretty significant. They're actually down about 20% at the extreme from their peak, and some people would actually declare that to be a bear market. Now you could see these out-of-phase cycles nest out over here in June. That is suggestive that the pressure could still be in these markets way out into the summertime right there, which we think is a possibility based on our monthly patterns. So this you could see negative configurations, this downward trend going on, and the likelihood of a decline coming out into June here in the emerging markets. So we looked at the emerging markets, we looked at the European markets, we looked at the U.S. market, and all of those in alignment for downward movement, taking you into spring and potentially into the summertime. That is suggestive that equities are going to be in a problem time frame in here. There will be a period coming out sometime, probably in the late spring or summer, where if these declines occur as the analysis suggests, and remember, our analysis is observational and probabilistic. When we bring it to you, we always know that there is some probability it will turn out differently. And when I look at the structures, I would make it at least 70-75% likely that this period of risk is going to bring declines in the market into this time frame. So, of course, we could always be wrong, and we will look at when the markets change and see if there are important messages coming out of that. Right now, it looks negative. One more little peek right over here at the S&P 500 for you to see what I just suggested was happening and how that compared to the European and emerging markets. And this decline out over here is likely out into the late March through early May timeframe is the way that is aligning right now. So that's a look at SPX and at the stock market for coming months, really outlooking as far as about 3 or 4 months in there for the major markets of the world. I hope you found that absolutely incredibly illuminating. I want to remind you, if you scrolled forward to watch our analysis and didn't see the earlier part of our show, we have a fantastic offer for our highest level membership. Go back and look at it, because I know lots of you either scrolled forward or are watching this on YouTube and didn't get to see the whole show. So please go watch the whole Market Week show and you'll see that great information, including the analysis that RV did on Danaher and discussion about the group, that whole healthcare group. And of course my monologue at the beginning, which I think has got valuable information and discussion about periods of zero returns, which I think we're getting into right now.